these level of losses, they are not the worst that they have ever been, but they're very close. We have only seen such levels of market distress or this level of poor market sentiment in the depths of the 2018 crypto winter.
Hello, everyone. Today I'm with David Lawant, Director of Research at Bitwise, and we're here to talk a little bit about the crypto market and everything related to that. Thank you so much for taking the time, David.
Thank you for having me, Giuliano, and hello, everyone. It's a pleasure to be here.
Perfect. So we're in the middle of what it seems a crypto winter. Is there any idea of how long this crypto winter is going to last?
Yes, this is a very good question. And if you allow me, I want to spend like a minute just explaining how we got here to then perhaps give some context about what we think might happen in the future. And I think the current situation we're in, the current bear market that we're in, had basically two different stages. It started at the very end of 2021. So if you look at, for example, the all-time high price of Bitcoin, it happened sometime in November last year. And the same is true for pretty much all the other crypto assets. That marked the top. And then from then on, we saw basically two waves of correction. The first one started again in around November 2021, basically was catalyzed by the Federal Reserve changing their stance from a dovish stance, right, from a stance that would benefit risk assets to a hawkish stance, which is a stance that is detrimental to risk assets in general and crypto, and we can talk more about that. Crypto definitely fits within risk assets, at least in terms of the return profile that the asset class has been showing recently. So the first, let's say, leg of this correction was basically that. And that's when we saw, just to use Bitcoin as a reference price, because this is the asset that most people have the price in their mind, this is when Bitcoin went from like the mid or even high 60,000s to something around 34 to $45,000. And that correction happened between November until probably April or May this year. At that point, the market was a little bit more stabilized in the sense that it had already adjusted quite a bit of their expectations for the Federal Reserve stance going forward. But then we had another leg of this correction, which was triggered by internal crypto issues, right? As you know well, I'm sure, and as probably most of our listeners know, starting probably in May in June this year, we started to see some companies and some players that were probably not adequately capitalized or that were not following the best risk practices. And we basically, in the very proverbial, when the tide goes down, you can see who is swimming naked and who is not. And it turns out that in crypto, during the last couple of years of bull markets, we had a few players who were actually, quote unquote, swimming naked. So we had a lot of players that had liquidity issues, solvency issues, and that's when we saw, to use again the price of Bitcoin as a reference, that's when we saw the price of Bitcoin go from the 35 to 45,000 range where it was to the 20,000 and sometimes even below that. So that's basically what happened during the second quarter of this year. It was the sharpest correction that crypto has ever been to date. In June, Bitcoin had its first month ever. So it was a very, very strong and sharp correction. Since then, we are mostly flattish, I would say. Of course, Bitcoin's still hovering at around 20K. Ethereum still hovering between 1.3 to 1.4 thousand dollars. So of course, there are trends, and sometimes the market moves a little bit up and a little bit down. But I would say that we have been mostly flat, which brings us to where we are now, and what are we expecting going forward? The first thing I would say is that I think that and not to I don't want to state the obvious, but I think that the worst is probably mostly behind us. You can see that in some on-chain indicators, for example. So
Yeah.
if you look at the percentage of the Bitcoin supply that is currently facing unrealized losses, so people who bought their Bitcoin or who transferred their Bitcoin for on-chain analysis purposes at a price higher than it is now, it's over 50% for Bitcoin. And for Ethereum, it's even higher. For Ethereum, it's about 60%. These level of losses, this is a market sentiment indicator we really like to track. These level of losses, they are not the worst that they have ever been, but they're very close. We have only seen such levels of market distress or this level of poor market sentiment in the depths of the 2018 crypto winter, during the during the COVID crisis in March 2020, and that's kind of it. So basically, what I would expect would be to potentially, I would not rule out another leg down. I think there's still a lot of macroeconomic trends potentially unfolding. We can talk about that if you'd like, but there's a lot of macro developments going on that could potentially have a repercussion on risk assets, and crypto might suffer. But I think that the bulk of the movement has already happened.
Interesting.
Yeah.
Yeah. So it seems that we're oversold, in terms of a few metrics, and you mentioned that you're basically showing a few data points, but the Fed is still raising rates, right? And when it keeps raising rates, then you have risk assets going down. Even though, the stock market is crashing, real estate market, like every single asset is crashing, but the Fed is still raising rates. There's an argument that they will have to pivot probably next year, because it's gonna be so bad that they will have to. I mean, we saw what happened with Bank of England. They are pivoting and printing more money. Is that is that a fair assessment? Will assets like crypto assets still is that the reason why they can keep going down, is because the Fed will keep raising rates, or are there other macro factors that can interfere with this bear market?
I think you're bringing a lot of good points, and I agree with you. I think that the Federal Reserve still has a very strong stance. So if you look at the rhetoric from a lot of the Federal Reserve directors who were less than a year ago saying that inflation was a temporary phenomenon, now they're saying that inflation is hell and that we need to go as far as we want to go to quash this demon, right? So the Fed has, and not only the Fed, most of the global central banks around the world, they're currently boasting a very strong rhetoric against inflation. I think the question is that actually there's a few questions here. The first one is that what are the transmission mechanisms, and how much of the current tightening is already reflected in economic activity, right? And we all know that there is a transmission mechanism that can take a few months, maybe a few quarters to transmit to the economy. And we have just been through a pretty historic tightening process so far. I think this is probably an unprecedented tightening cycle in terms of the
It's the
speed.
fastest. Yeah.
Yes, yes, that's true. So I think that we're probably going to start seeing some of those ripple effects over the next months and quarters, and that could lead the market to, or even the Federal Reserve to start thinking about whether it's time to stop or even to reverse the current hiking cycle. The reason why I think that crypto could still could potentially still go down from here is that on one end you can argue that most of the surprises that we're going to see from here on, they're probably coming from the economic activity side, right? I think it will be hard to have a lot of surprises on the Fed hiking more than what the market is already pricing in or what they are already expecting, unless inflation really takes off. But then that's another problem. So I think we're going to see a lot of the attention moving towards economic activity, and that reflects in risk assets through perhaps lower earnings estimates for companies and things like that, from which crypto assets are mostly neutral to. But the reason why I would not rule out another leg down, I'm not saying it's going to happen. I actually think it's most likely not to happen. But if it could happen, is that whenever you have these changes in the lag of the macroeconomic cycle, I think the market gets a little bit uncomfortable. These changes, these transitions from one leg of the cycle to another, they're usually uncomfortable. And we could see like perhaps a more generalized sell-off. But barring that, I agree that I think a lot has been thrown, a lot of at crypto. I think expectations are pretty low at this point. And although I would not rule out another correction from here, when I think about the outlook within a 6 to 12-month time frame, I'm actually very positive, as positive as I've ever been, maybe.
Awesome. So I want to just go into detail of something that you mentioned. You mentioned that maybe crypto doesn't like the earnings outlook doesn't affect as much crypto. Is that what happened recently? Like I think there was for some time this year, and past year, maybe crypto was a little bit correlated, with the S&P 500 and whatnot. But most recently, like in the past few days or in the past week or so, there was a little bit of divergence. And I'm not sure if that was correlated, with all these earnings talk. FedEx, missed, like had a big miss, and then Apple most recently, apparently they're cutting production, and the stock market is showing weakness there, but Bitcoin and the whole crypto market is not. Is that the reason why,
Yeah.
or?
Yeah, I think you're right on. The way I think about it is that at least until very recently, most of the stock market correction that we saw was basically on the back of the higher interest rate environment. There wasn't that much of earnings revisions or downwards earnings revisions baked in. And I think that this is something that we're just starting to see right now. And perhaps I exaggerated a bit. I'm not going to say that crypto is completely completely impervious to changes in the in earnings or in economic activity indicators, but I would probably say that it should be less so than stocks or even corporate bonds or these instruments that strongly reflect cash flow activity from a certain entity, right? And I think you're right. I think it's been a very interesting week or a couple of weeks in the sense that we're seeing stocks going down. Perhaps even more importantly, we're seeing pretty much every single currency outside the US dollar tumble over the past week or 2 weeks, and Bitcoin is holding pretty steady, which I think is actually quite impressive and an interesting signpost. There was a headline on the New York Times that I'm sure you saw that one that said something along the lines of currencies are around the world are tumbling except for Bitcoin. And if anyone told me that we would see such a headline in the New York Times just a couple of years ago, that would sound outrageous. But that's where we are. And yes, I would say that the past few weeks, they have been very interesting in the sense of how much crypto has held up, especially compared to these other assets. I think it's probably too early to tell and to say that a trend has been established, but it's definitely an encouraging sign, I think.
Interesting. So going back to the fact that, crypto is somehow correlated, like the interest rates are affecting, how crypto assets are doing. There was a lot of like talk about the fact that, like Bitcoin could be digital gold. That was like, I think, a good analogy. But gold, as we saw, hasn't gone down as much. We have liquidity problems in the market, and that may push gold a little bit down, but it might go up, eventually, when these liquidity problems are out of the market. Uh, like, is Bitcoin digital gold, or is it not, or are we too early because we're like very early in the adoption curve? Like it's this exponential, and then you have like 100 million people, and because you're really early in the adoption curve, it means that it acts like other risky assets, like tech stocks, high growth tech stocks, and whatnot, or like what's going on there?
Yeah, that's a fascinating topic. I think Bitcoin is digital gold, but that doesn't necessarily mean that Bitcoin replicates gold in the digital realm. I think that Bitcoin is better than gold, at least in many aspects. And one of the cool things about, let's say, transporting gold to the digital world or putting gold on the internet is that it is, when you do that, you can transact with the bearer asset in a counterparty risk way, in a way that you just couldn't do before, in a much more efficient way than before. So where I stand on this discussion is that yes, I think Bitcoin is digital gold, but I do think that when you make gold digital, you add some very interesting properties to it. The thing, however, is that Bitcoin is an aspirational gold type of asset, or it's an emerging monetary asset. And what that means is that it it will, at least in the short term, be impacted by a number of different price drivers that are different than the one that impacts gold. So I wouldn't expect Bitcoin to act exactly as gold does. And by the way, if it actually does, the upside would not be there, right? I think a lot of the upside lies in the fact that there's still a learning process, there's still a utility discovery process going on around Bitcoin. And these are basically the main drivers around the waves and the appreciation trend that we have seen over the last few years. I think there's still a lot more to go. And I think that, especially over the next few years, we might be able to see how Bitcoin is better than gold, in that sense that when you bring gold to the internet, the amazing things that you can do that you were not able to do with gold in the physical world, let's say. But that's, I feel like, something that is probably going to become more relevant in the upcoming trend. So yeah, I hope that was
That
a
was
helpful answer.
that was great. Yeah. So I mean, we have this digital goal that like the issuing and the supply is very predictable, which is really
Yes.
great. if I'm an investor, I would like, and wanted, to put my money into Bitcoin and crypto. There are a few ways, and Bitwise is, a great way. And it seems that in the market there is, ETFs. There's an ETF that tracks Bitcoin. What like how does that work, the ETF in the market, and is that the best product that can exist in the market? Can you go a little bit over? Yeah.
Yes, no, this is an awesome question and pretty much in our alley because uh, we at Bitwise were better known in the market for two things. Number one is for introducing the idea of index investing in crypto. So today we run the first and the largest crypto index fund in the market. And the second thing is as well for our ETF expertise. So at Bitwise, we have a lot of expertise in the ETF side. We have some folks, including our CIO, Matt Hogan, who are kind of uh, the founding fathers of the ETF industry. And we have been engaging with the SEC and trying to approve a spot Bitcoin ETF. We have been doing that since 2017. We have already done two filings that have been rejected by the SEC. But there's another type of ETF that has been approved a while back. And I think it's important to understand the difference between these two instruments. I'm sure you do understand these, but perhaps for our listeners, I could spend a minute just saying how they're different. The spot ETF is basically an instrument that encapsulates a direct investment in Bitcoin, right? So you're buying the Bitcoin spot. The types of ETFs that we have seen approved, they basically don't buy Bitcoin directly, but they buy Bitcoin futures contracts that trade in the CME, in the Chicago Mercantile Exchange. This is the main difference, and it would make these two instruments very different. The ETF that has already been approved, first of all, it's a great step, but we do believe very strongly that ultimately the best instrument to have ETF exposure to Bitcoin is through a spot ETF. The issue with having futures is that there is a number of drags in the returns that can be experienced through things like rolling these contracts, also to the premium or discount that the futures contracts can trade relative to the spot market. There are potentially some tax implications. So overall, the futures instrument will probably lag the performance of Bitcoin. The amount of this drag can vary. I think I saw some people estimating that it could be between 5 to 10% a year. So that's kind of the main issue with the futures-based ETF. It has this drag that pushes returns down. A spot ETF would not have that problem, but at least here in the US, the SEC has not yet approved a spot Bitcoin ETF. That is one of the work streams that we engage in. And I don't think we're going to see that anytime in the near future. But when we think long term, we think it's just a matter of when and not a matter of if. I think we'll eventually get to a spot Bitcoin ETF approved in the United States, just like we have seen in other countries like Canada, even our beloved Brazil. So I think we'll get there, but it's going to take a while. So there are other options, like Bitwise offers other types of products like private funds or publicly traded trusts. There's a number of other ways to have exposure to crypto, but the spot ETF instrument is not a possibility right now here in the US.
Interesting. So it seems that, the spot ETF, like in terms of returns, is a clear winner. You may have a 5 to 10%, which is really big, significant. Maybe not in the crypto world, but it is like it's really significant if you're thinking of investment that over a period of 10, 20 years. What's the counter argument against allowing a spot Bitcoin ETF, and why is that right or wrong?
Yes. Yeah, you're very right. I think in terms of tracking the price of the underlying instrument, a spot ETF, I think would be the best choice here. And I don't think there's a lot of controversy around that. It doesn't mean that the futures contract cannot be good for some types of exposure, especially if you're looking for a short-term type of exposure. The futures ETF could potentially work well. But I think the reason the SEC has not yet been comfortable with the spot Bitcoin ETF is usually they attribute mainly to what they call lack of a regulated market of sufficient size. That is the very central part of the question that we have actually tried to answer in our last application. For those who are interested, there's almost 200 pages of research there showing that in our view, Bitcoin today has a regulated market of significant size, and this market is the CME futures contracts. But basically, the reason why the SEC is comfortable with the futures-based ETF is because if there is any event of market manipulation, the SEC basically wants to know who to go after, right? And if this market is fully encapsulated in the CME, they can have a higher degree of assurance that this market is regulated and things like that. We think that the CME market is a regulated market of sufficient size in the sense that it would be very hard to manipulate the Bitcoin spot market without engaging with the CME in any way. But I think that the situation where we are right now is also, it also transcends a little bit these technical issues, and it probably might have a little bit to do with the fact that both the SEC and the CFTC, which is the agency that regulates the commodities and futures markets, are kind of jockeying for who is going to regulate crypto, who is going to regulate crypto spot exchanges. And I think at least until we see some definition on that side, I don't think that we're going to see an end or the SEC getting comfortable with a spot Bitcoin ETF.
Interesting. And I'm a consumer, right? I buy crypto, in different platforms and whatnot. I haven't bought, Bitcoin through an ETF. Why does the average consumer should care about, the spot ETF and ETF, like Bitcoin ETF in general, ETFs in general? And especially crypto insiders, right? Like, why should they care that, that Bitcoin spot ETF? What would that mean to the market?
Yes, I think that the first reason why an ETF would be meaningful for let's say crypto insiders is that it would open a massive new market for Bitcoin adoption, or a massive new market to acquire Bitcoin exposure. And I'm probably better equipped to answer your question from the point of view of our clients. So our clients are usually financial advisors and RIAs. So they're by and large not self-directed retail. They are people who manage money on behalf of other people. And this is actually a very big pool of money, by the way. I think the last numbers I saw, if you look at the whole wealth in the US, retail was something between 15 to 20%. So that's like self-direct retail. What we call the institutional market is around 40%. So these are the pensions and the endowments. The other 40% is basically comprised of financial advisors. It's a market that is as big as the institutional market, and it's a lot bigger than the self-directed retail market. And this is the market that we focus on. And if I'm self-directed retail consumer, I can just go to an exchange and buy Bitcoin. And that works perfectly fine, especially if you're dealing with smaller amounts. Perhaps at some point you want to worry about your custody solutions and not being hacked and all that sort of stuff. But think about a financial advisor that has, let's say, 100 clients. I mean, how will this financial advisor open 100 Coinbase accounts? Or is this advisor going to have 100 Ledger wallets? How is this advisor going to charge and do taxes? I mean, it's relatively hard for crypto to slot in this market. So I understand that for self-directed retail, buying crypto directly is a good option or a good enough option for many, but there are also a number of different types of investors that have different needs and different restrictions that buying crypto directly in an exchange is just not a good enough solution for them. So we at Bitwise, we basically offer instruments that make this exposure, make obtaining this crypto exposure easier. The ETF would be the gold standard of this because it would allow financial advisors, RIAs to access this market in a very seamless way. Today, we have other things that are a little bit clunkier. They either require you to be an accredited investor, fill up some paperwork, or if not, you have to deal with discounts and premiums. So there's not a perfect instrument to have direct exposure to crypto for this public yet. And I think the ETF would basically solve that problem. And never forget, it's a pretty big market.
Yeah, I didn't realize how big it was. Like 40%, it's a lot.
Yeah.
It's much bigger than the self-directed retail market. Interesting. So we talked a little bit about Bitcoin and whatnot. Let's go over a little bit more over other crypto assets. So let's talk a little bit about Ethereum. It's the second biggest crypto asset, let's say in the market right now, and it has a huge ecosystem. Most of the NFTs are traded in Ethereum. You have applications, DeFi applications growing over. And recently, there was the Ethereum merge, right? And that was anticipated by a lot of people and eventually happened. What does that mean to the crypto market overall? How is that going to change the market?
Yes, this was a very big event, highly anticipated, as you said. We at Bitwise, we've been writing about the merge since March. And I think we were one of the first ones to come up with a well-rounded, well put together narrative around the merge, but we were definitely not the first one. So it's been a while. And one interesting thing about the merge is that it has been in the works for a long time. There is a mention about the merge, or actually about moving to a proof of stake system, in the Ethereum white paper, which was published in 2014, before Ethereum launched in 2015. So it's been in research and development mode for many, many years. And we finally reached that milestone on September 15th. So it was a very recent event. The merge is basically the event in which Ethereum changed a key part of its consensus mechanism from proof of work to proof of stake. And I used a lot of jargon here. You can probably think of the consensus mechanism as kind of the engine that makes these blockchain networks work. It is the mechanism that makes these independent computers in sync, that puts them in sync without any centralized party. So that's how they can know that they are more or less pointing to the same direction. And there's two ways to do that. One, which is the classical way, is what we call proof of work, which entails using these mining machines. I'm sure you and everyone here have already heard about the Bitcoin miners. That's what they basically do. They buy these machines that are very energy hungry. They consume a lot of energy, and this energy is basically used to secure the blockchain. That's why the Bitcoin network is so secure, because there's all this computation or this energy intensive computation going on. This is great for Bitcoin, and it works really great. And it's the best solution for what Bitcoin is trying to achieve, which is maximum decentralization, maximum censorship resistance, and these things. But Ethereum is trying to do something different. Ethereum doesn't optimize necessarily for these things, and Ethereum wants to be more programmable, and there is also a desire to reduce the energy consumption of the Ethereum network. So Ethereum moved from this proof of work scheme in which they use these energy hungry machines to this newer proof of stake systems, which use basically financial commitments. You basically pledge capital, and if you do something wrong, your capital is confiscated or it's slashed. It also uses some clever cryptographic tricks like some random lotteries and things like that. And this is basically the transition that happened. And this is very hard to do technically. I think the best analogy I've seen is to imagine that you're driving a car and you're replacing the engine of that car from a combustion engine to an electric engine while the car is driving without impacting any of the passengers. So that's basically what the merge was, a very big change. It has a lot of impact on Ethereum. It lowered its electricity consumption by over 99%. It has also made ETH, the digital asset that powers the Ethereum network, scarcer. So the issuance rate has reduced. And this is something that we can already see in the numbers right now. It's being reduced by over 90%. And it also allows holders of Ethereum or ETH to derive a yield on their assets in exchange for providing security work on the network. So these are kind of the three biggest impacts. These are pretty big impacts, and they change a lot the economic logic of ETH. But perhaps most importantly, and this is another benefit that is only going to accrue gradually over the next few years, is that it lays the groundwork for a series of other upgrades that are coming to Ethereum over the next year or two, mostly related to scalability, to allow Ethereum to handle more transactions cheaply. So that's basically what it is. It was a long answer, but it's also a big event and a very central part of the Ethereum architecture. And that's basically how it changes Ethereum. I think it does have an impact to the crypto market overall, in the sense that I think it makes Ethereum more different than Bitcoin. I always had a strong view that Bitcoin and Ethereum are very different, and I think the merge makes them even more different. And it also kind of levels a little bit the playing field, or it opens room for Ethereum to level a little bit more its playing field against its newer competitors. Ethereum has a bunch of competitors like Solana and Polkadot and Cardano and Avalanche and Near and others. These are all proof of stake systems because they're newer blockchains. Now Ethereum is also in this paradigm. So I think it starts to level a little bit the playing field there between Ethereum and their newer competitors. So yeah, big event, huge event, very exciting.
Amazing. So you mentioned that Ethereum is now separating itself a little bit from Bitcoin. When I think about Bitcoin, I compare it to digital gold, and that might be a silly analogy, but I really like to think about it in this way. And when I think about Ethereum, I may think about it as digital oil, because you're powering this global computer, which I think is also a social network, which I think is also like Ethereum is a bunch of things, but like when you buy Ethereum, I think you're basically buying digital oil. That's how I think about it. But the market doesn't care what I think about it. What they care about is how regulators may think about these digital assets, right? And has been a lot of discussion about who is going to regulate some of these digital assets, including Bitcoin and Ethereum and others alike. I think there was a little bit of discussion towards, making some of them commodities. Is that what's happening? What's happening there?
Yes, this is the great question and a very broad one. We could probably do a podcast only on regulation. And the thing with regulation is that, well, first, it depends on the jurisdiction. But even if we talk only about here, the US, regulation touches crypto in many different ways. So, yes, there is the securities or securities definition aspect that you mentioned, but there's also tax, there's also financial regulations more generally, consumer protection. So, it's a very broad theme. Today, I would say that the probably two hottest topics in regulation would be first stablecoins. There's a lot going on around stablecoin regulation, and the second, which is the theme that you just alluded to, which is how do we define which crypto asset is a security and which one is a commodity. This is a long-lasting discussion in the SEC for many years. And I think the view of the industry is that we don't have a lot of regulatory clarity. The SEC has said very clearly that Bitcoin is not a security, Bitcoin is a commodity. A few SEC commissioners have kind of voiced a similar opinion around Ethereum, but there's not, as I understand, not an official SEC view. And the rest is actually very murky. So there is a test that was basically developed in the 1940s. It's called the Howey test, but exactly how it applies to crypto assets is definitely not clear. And this is something that that the market has been increasingly asking for further clarity on. And there's also this aspect that I mentioned briefly in a previous answer, which is that the SEC and the CFTC, they're all kind of fighting for regulating jurisdiction over crypto. So yes, this is one of the big issues that if we get more regulatory clarity, it would be really great for the whole industry. Today we have, I mean, a very, I would say, relatively cloudy view. Some assets, I think we can relatively say that they are not securities with relatively with better confidence. It usually relates to how decentralized the network is. Although Gary Gensler, the SEC chairman, he has been avoiding to use this term directly. The way I think about it is about how decentralized the network is. But measuring how decentralized the network is very hard, especially if you move away from Bitcoin and Ethereum. There's just so many dimensions that a network can be more centralized or decentralized that is very hard to say with 100% precision which asset is a security, which asset is a commodity. But I think that we're moving forward on this discussion, and I would expect to see a lot more clarity in the next 12 to 24 months.
Interesting. And it seems that this is gonna, like, when we get clarity, that might be, a bullish point for crypto, because then, some investors that, are not necessarily entering the market, they may enter. But I think that ties a little bit to stablecoins. You mentioned a little bit, stablecoins. We have crypto assets that are tied, to different currencies. So, for example, USDC, which I think is issued by Circle, is tied to the US dollar. But I think they're not FDIC certified or insured. How does that affect the market? Can that regulatory and can that help if eventually when they are FDIC insured? If I'm saying it correctly, that can also drive adoption. Is that right, or like what's going on there with stablecoins?
Yeah, no, this is a great question, and stablecoins is one of the biggest crypto innovations and one of the real world use cases that really emerged over the last 2 years or so. I don't have on top of my mind the amount of stable coins outstanding in the market, but it's in the 100 billion plus mark. So it's a pretty relevant market. And stablecoins, as you said, Giuliano, they are crypto assets that track the price of a fiat currency. Usually, or in most of the cases, this currency is the US dollar. But there can be stable coins that track the yen, the euro, and I think there's even one that tracks the Brazilian real. The thing with stable coins is that they work in some ways a little bit like a money market fund would here in the US. And and there has been some regulator scrutiny going on around stablecoins for a while, but this has definitely gained a lot more attention after we saw the issue with Terra Luna and their stablecoin UST. That was, as you know well, a crypto ecosystem that came from kind of nowhere, but it emerged very strongly. I think at some point Luna was the sixth largest crypto asset in the market. And this all unwinded really, really quickly throughout the second quarter of this year. It was one of the triggers, or perhaps the initial trigger of that second leg down that I mentioned in the very first answer I gave you. I think the important thing to understand here is that UST, Terra Luna are a very specific type of stablecoins. They're called algorithmic stablecoins, so they're not backed by another asset. And these, in my view, is a pretty flawed design. I mean, a lot of people in the industry had that view. So we at Bitwise, we blocked Luna from joining our indices last year, like way before there were any issues. But some investors are still willing to bet on somehow we finding a magical solution that makes these algorithmic stablecoins work. But overall, today I would say they are fundamentally flawed, and I think it's impossible to make them work. And then you have these other stablecoins, which are the one, like you mentioned, USDC, Tether is another one, and there are others which are actually backed by US dollars in a bank account. So in that sense, it's a lot more about knowing whether the dollars are there, right? So just knowing that the backing of that monetary base is there. And I think we're going to see some regulation happening around stablecoins. Actually, we are already seeing there's probably a proposal coming to Congress very soon. And I think the main benefit of giving more regulatory clarity to stablecoins is that they can be used as perhaps even a day-to-day payment system for some in a much easier way than they can today. So it is obviously a lot easier for a large financial company or a large corporation to engage with stablecoins once they understand and they know that they're operating under a safe regulatory environment. I think we're going to get there pretty quickly. The attention has shifted very strongly since the last quarter or so, and I think we're going to get very quickly there. And I think this is going to be pretty helpful for stablecoin adoption, especially as it relates to larger and more established companies embracing this type of asset.
Interesting. And it seems that, a lot of companies are not adopting, USDC or other stablecoins. And that's not only in the US, right? Like dollars are used everywhere to transact. Would that, drive a little bit more the market, or is that, or do you think that's not going to interfere much with the market? Yeah.
You mean in terms of the crypto market more broadly using stablecoins?
Yeah, I mean, if the stablecoins are FDIC insured, I imagine, for example, Microsoft, right? Like they are not using stablecoins, to transact, and I imagine one of the reasons is because it's this weird market that you don't have much clarity of what's going on, and if you have more clarity of, oh, look, this is insured, by the federal government and whatnot, and you're sure that like this is
Yes.
the money is actually in the bank. Because right now we're just trusting, I think, Circle, for example, for USDC, right? It's not, and like, does that mean if we get to, maybe I'm wrong, the name is FDIC insured, would that translate to bigger adoption for companies in the US and outside the US, or is that not going to make a difference?
No, I got it. I got your question, and I think the answer
Yeah.
is yes. I don't know if stablecoins are going to end up FDIC insured, and I would say that Circle or USDC is probably the gold standard in terms of transparency. But you're right. This is basically a Circle initiative. There is no requirement. There's no standard. So USDC is audited on a monthly basis by a top 5 auditing firm. They have been by the way, expanding the range of or the transparency of their disclosure. But I think that we're probably going to see a established level of transparency, maybe some sort of certification in order for a stablecoin issuer to be able to operate in the market, and all these things ultimately they benefit adoption. And I do believe that large corporations like Microsoft and others, they would probably lean more towards adopting stablecoins once we get to that level of clarity.
Interesting. So talking a little bit about stablecoins and its correlation to the crypto market. So we're seeing right now, like very weird movements in the market, let's say. So the Bank of England had to act. It seems that they had equivalent to Lehman Brothers problem. It didn't happen, fortunately, but they had to intervene there. But like this problem that we're seeing, I think it's correlated to the fiat system. You have debt to GDP so high in all developed countries. You see in Japan, the BOJ is doing yield curve control. Now in the European market, you have the anti-fragmentation tool, which is the same thing. Bank of England's now, I think buying bonds and trying, basically doing price controls with bonds. I mean, yield curve control is the same thing. And eventually we might see that in the US this year, but it's like, it seems that the fiat system, the way it's done right now, it seems broken in my view, but it might work in the long run. At the same time, we see countries, like El Salvador, they're making, Bitcoin legal tender. And as that analogy is digital gold, right? Even though we're seeing, some moves towards, Bitcoin being digital gold, can we see it, like maybe 10 years, 20 years from now, Bitcoin or these other, crypto assets become currency, and that can be, can start with states, or is that not even possible because of regulation?
This is an amazing question. I think the answer is yes in the long run. And, one interesting thing is that we have very little information on how an asset gets monetized in the free market. Because the last time this happened was with precious metals. And this happened thousands of years ago. It's actually predates writing. So we have very little information on how things like gold and silver were monetized. We are seeing, I think, a similar process with Bitcoin, but it's really hard to know how this process takes place. One thing I think we can say with reasonable certainty is that, number one, this is a long process. There's a whole social aspect to it, people getting used to it, people understanding the utility of this money, why this could potentially be a better money, that takes time and it's really hard to speed up. So that's the first thing. The second thing is there is a general understanding that the process for something to become a currency has a few different stages. And the first one is for this economic good, this commodity, to start to be recognized as a store of value. So people start to accumulate this commodity because they believe that it will be able to sustain value over time. The next stage would be for it to be used as a payment method. So people will start transacting in that currency. And then the third and last stage would be when people start to use that currency as their unit of account, right? So this is a very long process. Bitcoin is going through, and if this framework makes sense, Bitcoin is definitely the first stage. Bitcoin is in the store of value stage. But I think there's a lot of things going on in the technology that will allow it to be a very efficient payment mechanism. At some time in the future, we can talk about the Lightning Network, which is this layer on top of Bitcoin that allows you to do very fast and cheap payments. It was kind of launched in 2017. It's still relatively small because most people don't want to spend their Bitcoin. They just want to buy it and hold it for the future. But I think at some point, as we go through the price appreciation cycles, I think at some point we're going to start seeing people using Bitcoin more as a quote unquote transactional currency, right? When we think about currency, we usually think about the dollar and buying a coffee with our dollars. Today, I think Bitcoin is a monetary asset more like gold, right? Gold is a monetary asset, but no one buys their coffee with gold. It's used more like at central bank, collateral management, type of specific hedges and that kind of stuff. So that's where Bitcoin is. But I can definitely see a version of the world in which it goes through this evolution curve and it starts to be used as a transactional currency. I don't think we're very far. I don't think we're very near. I don't think this is something that will happen anytime soon. But when I think within a longer time frame, let's say 10, 15, 20 years plus, I think that's a very strong possibility.
Interesting. And that ties together a little bit with, like Bitcoin. One of the advantages is that, the inflation rate, the amount of, new issue Bitcoin is very predictable compared, to any other country. Like even the
Yes.
US, they print so much money. But one of the other aspects, I think, of like crypto adoption, I think that's very big, and I think it's not talked as much is interest rates and like how borrowing and lending happens. That market is completely detached from the market that's dictated by government. So right now it seems that interest rates are not market driven. So like if you look at interest rates here in the US, the central bank says, oh, okay, like we will have 0% interest rates, and at the end of the day they're basically buying up US debt, like the central bank is buying that, and it doesn't seem that's market driven, and there's a big difference between interest rates in Brazil and the interest rates here in the US, and I think that's correlated with the trust in government. So like the US as an institution and the government's more trustworthy in the long run than the Brazilian government, even though there might be differences, every now and then, and that might drive it. But as an individual, right, like why should the cost of money for an individual in Brazil be much different from the average, consumer or person living in the US? For me, it doesn't make much difference, right? I don't know if that makes sense, but like, you see, there are companies that are emerging here and there, like BlockFi, where you can, borrow and lend Bitcoin. how like what do you think about that market and how, for example, DeFi ties into it?
Yes, this is a very deep topic and a very deep question. And I want to make a book recommendation here. It's a book that I haven't finished yet. I'm actually just starting. But there's a book that was just launched called The Price of Time: The Real History of Interest. It's written by Ed Chancellor, who is a pretty famous financial and economic historian. And he has a kind of Austrian way of interpreting economic phenomena that I respect and that I admire. And he says something. I mean, there's a few very interesting things in the book, but the way he defines interest is that if you ask a general financial practitioner what is interest, they'll probably say that it's the price of money. But if you think from a pure economic theory perspective, the best definition for interest is the price of time. So that's where he draws the title of the book from. And it's reflected in money because money is the common media of exchange. But interest is more like the price of time, and it is related to time preference and these concepts that are pretty popular in the Bitcoin community. But I agree with you. I mean, I think that under the operating framework that the world have of national currencies, I do understand different interest rates, right? So they basically reflect confidence in that currency. Typically, central banks, they can manipulate short-term interest rates more. They can do so for long-term interest rates. These things, they depend more on economic factors, institutional factors, even demographic factors. So they depend on things like that. But if we all lived in a world that had the same currency, right? So let's say if we theoretically brought back the gold standard, and if gold became money, or if Bitcoin emerges as this new gold standard, and Bitcoin naturally emerges as the global money, the interest rates would be pretty much similar. They would mostly reflect time preferences and not necessarily attitudes or decisions by a committee of central bankers in each country. I think it's a better model, but we're pretty far from it, I think. But yeah, that's how I think it works. And I think in the meanwhile, what we're going to see is Bitcoin being more and more used as a collateral for credit activity. As you mentioned, there's a bunch of companies that do that. Some of them got caught in the previous down cycle with relatively bad risk management policies. But I think that one of the interesting use cases of Bitcoin is as collateral for credit. This is probably something that is not super easy to do right now because of Bitcoin's volatility, right? If you use Bitcoin as a collateral and you take in US dollars, there's of course a big exchange risk here. But as Bitcoin's volatility goes down, I think that this is a market that is going to grow bigger and bigger from here on as volatility starts to taper off.
Interesting. So it seems that there were centralized finance companies that went down, but decentralized finance was pretty stable, right? And that was might be correlated to the fact that a lot of them are over collateralized. Like yeah. So yeah, that's interesting. What other interesting applications have you seen, in crypto that are not necessarily DeFi, right? Are there other interesting applications, or are we early in the DeFi space? Yeah.
Yeah, I think DeFi is awesome, and it's a very new and interesting way to create financial services and to use financial services. I always say that I think DeFi is kind of a way to build and use financial services as we do open source software, which I think is very compelling. But there are some things happening besides DeFi, beside financial applications, right? A big one we saw last year emerging was NFTs. This was an interesting trend. Some people are going to call it hype-ish. Some people are going to call it fluffy. I would also not buy a $1 million picture of a rock. I agree that this is probably overpriced. But the interesting thing is that there is this underlying aspect of you owning a digital item just as you can own a physical item. That can have a lot of interesting applications. They can happen in art, they can happen in the world of collectibles, but they can also move towards other interesting things. And I think that's one interesting application that goes beyond the financial realm. Oh, just to stay on another, like I'm gonna call it NFT related application, is Ethereum domain names, right? ENS. You can own your domain name. So let's say Juliano.eth, just as you can own Juliano.com, but without any centralized party telling you or giving permission to do so, and precluding you from transacting or benefiting from it if you'd like. So there are a few emerging, and I think we're going to see more. And the main reason why I think we're going to see more is that today a lot of these blockchains are hard to scale. So once we start to fit in too many transactions in the blockchain, they start to get very expensive to execute. So I think they price out a lot of non-financial use cases that we could have seen just because the financial use cases are usually very profitable. So like if you're trading crypto in a decentralized exchange or borrowing and lending, these things are very profitable and people can pay high fees. But if you're doing things that are more related to the things that we do on the internet and that might not necessarily entail a big financial value in it, they're hard to do. As blockchains expand their capacity to handle more transactions, I think we're going to start to see more of these non-financial applications coming to the market. There are a few already, like the ones I mentioned. There's gaming too. There's some interesting stuff going on there. But I think once we see more scalable blockchains, that's when I think we're going to see a pretty interesting new wave of non-financial applications coming to crypto.
Interesting. Yeah. There is this thing that Fred Erstrom, former co-founder of Coinbase, and now is a partner at Paradigm, that he talks about, and he says like crypto enables the metaverse, and it's kind of like the metaverse. It's like this hyped thing, but I think it has a lot of truth into it. Like the metaverse is the multiple universes, and with like crypto, you can own digital goods, as you mentioned, NFTs, for example, and take it anywhere, right? Like if you go to Instagram, you can own your NFT, and you move, to another application, it's still yours, right? So it enables these multiple universes, like you're basically taking your digital goods. On that note, it seems that NFTs are really early on, even though, there's like a big, there was a lot of hype around it. Like, what's the most bullish case for NFTs as an industry, right? Like, I think Bitwise has NFT, product, and like let's say 10 years from now, like what's the bullish case for NFTs as an asset and also as an industry?
Yeah, this is a great question and a very interesting thought exercise, right? I don't wanna say that I know the answer to this question, but I think that we at Bitwise, we spent a fair amount of time thinking about the NFT space. We launched the first NFT index fund in the market. It is a fund mostly focused on the collectibles and art space. So you can think about a fund that owns things like CryptoPunks and Bored Apes and these blue chip NFT collections. But thinking 10 years down the road, I think that NFTs can go way beyond just the concept of art. The whole idea of owning a digital item as you can own a physical item, as I mentioned before, I think it could have a lot of applications. Some that might seem small, but think about concert tickets. These things could become NFTs. There's a lot of chatter on NFTs moving beyond just pictures. So it's probably gonna to start seeing music NFTs and things like that and going forward. But I think that in the future we could see pretty much any real world asset reflected as an NFT. If we start to see this bigger uh, this bigger connection between the real world and the crypto world, I think that we can see a lot of transactions that could actually be of traditional items happening as NFTs. And as our life becomes more and more digital, right? You mentioned the idea of the metaverse and people owning digital real estate and gaming items and things that they appreciate. All these things can probably be made reality through NFTs. So I think it's a pretty important and interesting technological primitive that is going to potentially yield into many different applications going forward. Hard to tell right now how it's going to look like, but what I think is pretty clear is that this is a very interesting and new way of doing things that was just not possible to do before.
Interesting. Last topic around crypto is, DAOs. We've seen the emergence of DAOs, decentralized autonomous organizations, which seem somehow the digital version of, companies or organizations like that. Like, what's going on there? Are there any interesting projects that, are happening? I think one of the most interesting projects that I've seen is Nouns, if I'm pronouncing it correctly. They tie together NFTs and DAOs. But yeah, anything interesting that you're seeing there?
Yes, I think if you ask a lot of crypto investors and industry participants, if you ask what the next big thing in crypto could be, a lot of people would say DAOs. And there is a number of interesting DAO projects. So basically, a DAO is a way to organize human collaboration towards a shared goal through crypto design mechanisms. So you mentioned Nouns DAO, which is very cool. It's in, I think you put it well. It's in this this border between NFTs and DAOs. There's NFT collection DAOs, actually some pretty big ones. So imagine that there is a good that you think is very valuable, that it should be a public good, shouldn't be owned by anyone. So you can raise money in a DAO and acquire that good. They even tried to buy the US Constitution. I'm sure you saw that episode. They got pretty close, but they didn't make it. So there's a bunch of initiatives going on that side. There are things happening on the sports side as well. Imagine a soccer team that is managed, or a sports team that is managed as a DAO, and you can delegate some of the activities to the owners or to the participants of the DAOs. I think there's a golf club that is also managed as a DAO. So it's a very interesting way to organize human collaboration that is not is also something we couldn't do before. The one thing I was going to say about DAOs is that it might be, however, more difficult to do than it sounds, because you need to spend a ton of time on governance and how to structure these governance processes. Even, I mean, if we think about some of the earlier DeFi projects, like you can think of MakerDAO, that has a pretty active governance structure going on. It has a few kinds, sometimes going through a few challenges, because it's really hard to listen and take into account everyone's view and organize that within a governance process. It's not a trivial task to do, but definitely something that DAOs have been tackling in a very interesting way, and I'm sure that many interesting projects are going to emerge from that.
Interesting. Yeah, I agree with you there. This was like an amazing conversation. Like it was a pleasure talking to you. Anything else you want to add, to our viewers? Like anything you wanna talk about? Or...
It was great talking to you, Giuliano. I hope you all found this valuable. Well, the only thing, I think we covered a lot of ground actually. We went
Yeah,
from macro to Bitcoin, Ethereum, a little bit of DeFi, NFTs, and DAOs, and more. So I think we covered quite a bit. For those who are interested in learning more about my work, you can find me on Twitter. My handle is dlawant, DLAWANT, or you can go to bitwiseinvestments.com. We have an insights page there where we published a fair amount of content related to crypto. We do white papers, we do research briefs, we do investor letters, we do webinars, so we do videos. So there's quite a bunch of stuff there. And you can, for those who are interested in digging a little bit more, that could be a good way to start.
yeah, I agree there. I've read a bunch of the reports, seen a few webinars, and they are really, really high quality. I think one of the best in the market, if not the best, report. So really recommend those resources. Thank you
Thank
so
you.
much.